Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
Distraction's not going away, but one individual that is hyper-focused on the actual policies that were discussed this week is, of course, the NATO Secretary General Jens Stoltenberg, and this was his final NATO summit. You're going to be retiring in the fall. You've been at the helm for a decade, so you've seen a lot. We're going to get into some of those distractions that were happening at the summit, but I want to get into some of the policies. We just heard President Biden there talking about the limits they've placed on Ukraine about striking deeper into Russia. He basically said they don't want to give him capacity to hit the Kremlin. But Zelensky is asking to attack Russian jets on Russian air bases that strike Ukrainian cities. Do you get the sense that the U.S. doesn't trust Zelensky?
Well, first of all, the U.S. and other allies have loosened the restrictions they have imposed on the use of the weapons they have donated to Ukraine. So Ukraine is now able to also strike against military targets inside Russia. And we need to remember what this is. This is a war of aggression. Russia has attacked Ukraine. That's violation of international law. Ukraine has the right, according to international law, to defend themselves. And that includes also striking legitimate military targets inside the territory of Russia. And some allies have given them that permission. Other allies have some restrictions, but they have been loosened up a bit.
But of course, the most important ally sending the most weaponry is the United States. And they've only said you can go about 40 kilometers. But to really, Zelensky's point is to really start to push back the Russians and be defensive, they need to get on top of it, meaning going maybe 300 kilometers. Do you think, I mean, you were part of these discussions, do you think this is something the United States, we've seen them before drag their feet and then make decisions that Zelensky was pushing for. Could you see them coming around to this?
This was an issue that was discussed at the NATO summit. And again, some allies have no restrictions on the use of the weapons they have delivered. Others have restrictions but have loosened them. The US is, of course, important, but half of the military support to Ukraine comes from non-US allies, comes from Europe and Canada. So when it comes to Ukraine, the Europeans have really stepped up, and with the decision we made at the NATO summit to have a long-term pledge and to have a formula for burden sharing, we will ensure that also in the future European allies and Canada will provide half of the military support because they have half of the economic strength of the alliance.
Ukraine didn't get the formal invitation they were hoping for. So they are still at the gates, knocking on the door, and they're not let into NATO just yet. While they do this, though, it unnerves Putin. Do you think they're, in a sense, almost the worst position, this security purgatory, because they're still stuck in the middle, because they're not yet in alliance, but even asking to be in alliance really underscores the issue that they're having with their neighbor next door?
At this summit, allies were very clear that Ukraine will become a member. We also stated that this is a reversible path towards a membership, but actually as important, or perhaps even more important than the language in the statement we agreed, is that actually we took actions to move Ukraine closer to membership. We established a NATO command with 700 personnel to organize the provision of training and military support to Ukraine. We agreed this long-term pledge, and we stepped up the work to do what we call interoperability, to ensure that Ukrainian forces are fully interoperable with NATO forces. These are concrete actions that actually helps them to prevail, to help Ukraine to prevail as a sovereign independent nation in Europe. And all of that moves them closer to membership. And then when the time is right and allies agree, they will become members straight away.
As you know, politics overshadowed this summit. Everyone was talking about, if not officially, unofficially, President Biden's age. As the NATO Secretary General, who's worked with both of these U.S. presidents who are the candidates for November, do you see potential change in the future U.S. commitment to the alliance?
I expect that the United States will remain a strong NATO ally also in the future for at least three reasons. One is that this is in the U.S. security interest to have a strong NATO. In NATO, the United States has something Russia and China doesn't have, more than 30 friends and allies. Second, it's very strong bipartisan support in the United States for NATO. In the public, we have seen new opinion polls also confirming that, but also in the U.S. Congress. I met congressmen from both parties, and they all express some strong support to NATO. And thirdly, the main criticism from former President Trump and others have actually not been against NATO. It has been against NATO allies not spending enough on NATO, and that has changed. Over just the last years, we have seen a significant increase in the number of allies spending at least 2% of GDP on defense, which is the NATO guideline. So
is your expectation to ignore potentially your expectations that Trump's rhetoric will not match his policies on the ground?
Well, I worked with him when he was Prime President last time, and again, I expect that the United States will remain a strong NATO ally, because this also makes the United States safer and stronger. The United States is big, 25% of the world's GDP, but together with NATO allies, we are 50% of the world's GDP, twice as big, 50% of the world's military might, and this makes the United States stronger. And the main criticism, the fact that European allies didn't spend, that has really changed. 23 allies spending 2%, and those allies are not yet at 2%, have a promise to be there soon. So this has really improved, not least because the criticism from the United States was valid, and Europeans have heard the call and have stepped up.
Jens Stoltenberg, thank you so much for your time. That was, of course, Jens Stoltenberg, the outgoing NATO chief.
Keith Lerner of Truist staying bullish, saying this: stocks are in a bull market that deserves the benefit of the doubt. Moreover, strong first halves tend to lead to further gains by year end, albeit with normal corrections along the way. Near term, we anticipate the stocks will trade in a choppier fashion, but still, the primary uptrend appears intact. Keith's with us for more. Keith, I want to build on what Lisa's been talking about. I think it's perfect. It's the way to think about things. Yesterday, we had some data that spoke to this Goldilocks optimistic, constructive view of things. We also had some earnings that said the opposite. And Keith, I'm wondering how you view things, both on the economic data side of things and through the lens of earnings in the last 24 hours.
Sure, and great to be with you all. Yeah, yesterday was an interesting day. We actually downgraded a tech in late June after upgrading it in November. And basically our view was that, after a 40% gain since we upgraded it, that things had gotten a little bit too stretched. And in July, we saw the tech sector continue to kind of grind higher. On the other side, what we saw on this kind of mean reversion trade, the rubber band just got too stretched. The relative performance of small caps up until yesterday was at on a 6-month basis, was at the greatest underperformance we've seen since 2000. It was a 20% underperformance over 6 months. It's incredible. The average stock, the eco-weighted index, also had the greatest underperformance on a 6-month basis since 2000. So I think what we're seeing right now, what happened yesterday, Jonathan, is the rubber band got too stretched. And basically, a little bit of good news went a long way for the other stocks. We got that broadening that everyone's looking for, but when that broadening is happening, those big cap tech stocks came in, and the market below the surface was strong, but the headline index was weak. So it's kind of interesting in the way this kind of played out.
I have this image in my head of kids in a rubber band fight, stretching it out, waiting to kind of let go. The letting go yesterday was the potential for rate cuts on this sort of Goldilocks-like kind of environment. At what point do you start to get concerned that maybe it's still not threading the needle perfectly, that some of the guidance that we've heard from banks, from other companies that have reported earnings so far, it is early days, signals something else that might portend a bit more weakness?
Well, I do think we are seeing a cooling of the economy. We wouldn't call it weak, and I expect that earnings will be fine. Probably not the blowout that we've seen in the past, but enough to continue to move the market forward by the end of the year. Forward earning estimates continue to grind higher, and I will say, I think the one lesson during this whole period we've seen the last couple of years is don't underestimate corporations' resiliency around profits. Right? We had this once-in-a-generation pandemic and inflation backdrop, and we've seen corporations handle that pretty well. So again, I do think we'll be in a little bit more of a choppier fashion here near term, but I do think the underlying trend for the market is still is still higher, and the economy is just moving more towards a trend growth from this really post-pandemic stimulus, boom that we had. That's behind us now.
Let's talk about some of the areas where we're seeing a broadening. Smaller banks, for example, which has been one of the most beaten up areas. And we saw some gains yesterday. As we get some of the bank earnings from some of the behemoths, JP Morgan, Wells Fargo, and Citi, is there a takeaway that makes you more positive, more constructive, just in general in the financial sector?
Yeah, I think timeframes matter, right? So longer term, we still actually like tech on a longer term basis, and we think there'll be an opportunity to redeploy there. On a shorter term basis, I just think that areas like the financials, even the smaller financials, along with some of the industrials, even places like the REITs will likely outperform because the expectations are so low. So I think right now, I think we should be thinking more about how things are coming in relative to expectations. I think some of these areas that have been beaten up where, the small cap index, S&P small cap index was actually negative for the year up until yesterday, that the expectations are low. I think when you think about the tech side, I think expectations there are a little bit higher. So I think we're going to have maybe more of that bifurcation during this earnings season.
Keith, give us some clarity on financials. Not exactly left for dead. Bank of America's up 24% year to date. Goldman's up 24%. Citi's up 27%, close to 28% before today's moves, granted. Keith, are you talking more specifically about the smaller players, the regionals, the mid-sized lenders?
Yeah, that's right. Yeah, I'm sorry. Yeah, that's right, Jonathan. I mean, what's interesting was like yesterday during that big rebound, the big banks were actually down because what we've seen, it wasn't just tech. It was this gravitational towards the highest quality companies in the different sectors, so not just tech. So what you saw yesterday is the smaller banks actually outperformed and the other ones came in a bit. I think we'll see more of that just because of that divergence. Again, longer term, as we move past this kind of snapping back of the rubber band, which I think could last, weeks, if not a few months. I think the rotation will go back towards these larger quality companies. I just think it got overdone as far as just the quality theme on a very short-term basis. And we're going to see more of that unwind because positioning has further to go. Based on our work.
Got it. Keith, thank you, sir. Keith Lerner of Truist on the latest in this market. To respond to the data we just got and the data we've had over the last few weeks, I'm really pleased to say that a good friend of ours on this programme joins us now. Mohamed, El-Erian of Bloomberg Opinion and of Queen's College, Cambridge. Mohamed, wonderful to end the week with you, sir. Let's just work through this economic data we got this morning and the data yesterday as well. When you look at the totality of the data, what kind of conclusions are you drawing currently?
So I have two conclusions when you look at the totality of the data. One is based mostly on the CPI, which is that what we're seeing is demand destruction and a loss of pricing power. When Mike McKee commented on it yesterday, he said it's very broad-based, benign inflation numbers. And you're really starting to see the demand destruction and the loss of pricing power. And that's consistent with what we've heard from companies, and it will be consistent with what we will hear from companies next week and the week after. And it is also consistent with the macro data that's starting to weaken. So that's conclusion number one. Conclusion number two is on the cost side. We're living in a global economy that, despite China's deflationary impact, is not giving us the sort of deflation that we'd like on the PPI. The supply side simply isn't there to help what's happening on the demand destruction, which is going to force something that you don't like me talking about, but I will, that there'll be a lot more discussion as to what's the right inflation target, given that the dual mandate. So I expect the Fed to focus much more going forward on the two-sided risks, and within that, much more on the employment side of those risks.
You brought it up, so let's talk about it, and then we can talk about the labour market. Mohamed, the right inflation target. The question that the chairman's been asking for a while, and he talked about it in his testimony twice this week. It's their question. Are we on a sustainable path back to 2%? Do we need more confidence? And he said repeatedly, we need more confidence. If some officials start to say that they believe they are confident we're on a sustainable path back to 2%, not 2 point something, not 2.5, not around 3, but 2%, why would you caution them? How are you thinking about the world differently? Why do you think that's going to be so difficult?
So if they just say we're on the path to 2% and leave it wide open as to when we're going to get there, already the chair has said we won't get in there in 24, we probably won't get there in 25. If they leave it wide open, I'm fine with that. If, however, they feel that they need to deliver the 2% either this year or next year, I would worry as to all the undue losses to output. I would worry about the employment side as well. John, the only thing keeping segments of the household sector, the lower income one and the small business going, the only thing keeping those going is labor income. And if we lose labor income, we no longer have the balance sheet strength that we had before, and it will result in a much, much stronger decline in demand.
Mohamed, what you're saying is fascinating at a time where Steve Risciuto yesterday came on of Mizuho and said his fear is you are seeing companies lose pricing power, as we saw from Delta and Pepsi. At the same time that supply side inflation is still present, his worry is that leads to margin compression now. If the Fed cuts rates, they'll be able to pass along those price increases to consumers. Inflation will go higher from here. Why is that a preferable outcome in your view?
So I listened to him, and the only question I asked myself is, what about the lags? What about the lags? It's not going to happen instantaneously. In fact, we still have the lagged effects of one of the most concentrating hiking cycles in history. So the lags right now are working the other way. So it doesn't work instantaneously. That's not how monetary policy works.
So when you talk about the labor market, and let's go there, because yesterday we got a good sign in terms of initial jobless claims and how much they actually came down below expectations. Why are you looking through that as an anomaly, a blip, rather than a sign of strength underpinning the economy?
So you said earlier, how much should we conclude from a data that's every month? How about every week? The data, the jobless claims data is inherently noisy. If you were to take a moving average of 3 months, 6 months, there is absolutely no doubt that you will see that indicator is not as strong as it was before. Now, from week to week, it will differ enormously because it is noisy data.
At this point, when you talk about we should really be thinking about what the right inflation target is, what's the correct balance between inflation target and employment at a time where we're talking about something like 4.1% on unemployment, and you're talking about inflation of 2%?
Yeah, and it's this notion of undue damage to employment and to the economy. There's also a very important distributional effect here. So it's pretty easy now because the Fed told us that they expect unemployment at 4%. We are above that number in June, and we're likely to go even higher than 4.1%. So already that part of the mandate is flashing yellow. Meanwhile, the other part of the mandate, even though the chair didn't call it as such this week, but did call it last week, the disinflationary trend is continuing. The big question is disinflationary trend to where and at what time? I think the Fed will keep this wide open. They'll keep on saying 2% is our target. We'll get there when we get there. They're not going to sort of be very precise as to when they're going to get there. And they're going to wait and see how the economy accommodates. And that's the way of doing slightly higher inflation targeting without calling it that.
If you are just joining us, welcome to the programme. Lucky to have with us Mohamed El-Erian. Moments after we got PPI data, I want to go through some of that data for you, coming in a little bit hotter than expected. Going into that print, the Russell of small caps was up again by something like 1%, faded off the back of it, then started to climb again. We're positive again by 0.75%. If you switch up the board and turn to the bond market, going into the number, yields were lower at the front end by a couple of basis points. We've erased some of that move. We're just about unchanged now in the session at about 450.82. Not major moves, Mohamed, but they're the moves of the last 10 minutes or so. You said something interesting, many things in fact, but I want to pinpoint just one. And you said the labour market was starting to flash yellow. When you hear from the Fed chair, he describes the labour market as being strong and a reason to get this right. You've said before that this Fed should be thinking about moving in July, not waiting until September. What is a couple of months between friends? Why do you think it is important to start getting going and getting moving earlier and sooner rather than later?
If I was as certain as the market is that he was going to move in September, I will tell you that a couple of months, there wasn't much in it. However, you have two factors that may complicate a September cut for this Fed. And I want to stress for this Fed. One is they may get one bad data point. And then because they're so overly data dependent and they're not looking forward enough, that could postpone the first cut to November. And then you're starting to talk about a longer lag. The second issue is the politics, John, is what does the politics look like when we get to September? And how worried are they that there's going to be an inflationary shock coming after the elections due to policies? So it's not as simple as saying, well, the market thinks it's over 80% probability it's going to happen, because this Fed is very impacted by high frequency indicators.
Let's flip this on its head, because a number of guests have come on the show and said that the big fear for the Fed and the worst case outcome would be if they had to reverse course and hike rates again at some point in response to an inflationary shock. Do you think that isn't that big of a risk, or it wouldn't be that problematic if they had to reverse course, say next year, after starting cutting either in July or September?
So I do agree it's their biggest fear. They don't want to be in any way resemble to the 1970s, and it is a huge fear. And they've already made two mistakes in the last 3 years. First, a transitory call that was horribly wrong, and then secondly, at the end of last quarter, they got too excited about what was happening on the inflation numbers, and they had to reverse their view. And we saw the amount of pivots. I've never seen so many pivots in forward guidance. The whole point of forward guidance is to provide smooth market adjustments. Instead, we've had this enormous number of pivots in the signals from the Fed. So I understand that hesitation, and I agree that this will be in the back of their mind. If they do have to hike next year, I think it's a low probability, but if they do have to hike, it is because something has happened either externally, we've had a major shock somewhere, or the policies elsewhere, fiscal, trade, have fundamentally changed. And I think people will understand that, and they won't blame the Fed. They'll see that there's something else that has happened elsewhere. No one blamed the Bank of England when it had to respond to the Liz Truss moment. I don't want to say the U.S. is going to have a Liz Truss moment. It will not. But people understand the credibility of an institution when the shock to inflation is coming from outside.
Mohamed, final question. Do you have more confidence, more faith in Chairman Powell's Federal Reserve or Gareth Southgate's England team?
Well, that's a really, really tough question, John. And I think, at every interview, you get very close to the line, as Paul McCulley used to say, that separates courage from stupidity. I think I'm going to stay on the right side of that line.
Mohamed, it's good to catch up. It's a lot loaded in that response. Mohamed El-Erian there, the brilliant Mohamed El-Erian from Queen's College, Cambridge.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.